So today we're doing the UK stocks I'm buying July 2025 edition. So I've got 3 stocks for you guys that I've been buying recently. These are all stocks that I bought from the 1st of June to the 1st of July. And a little bit of a slower month. I didn't buy as much as what I normally do. The reason why is I just didn't see that many opportunities out there. And I did trim one position slightly, so I'll reveal that all for you today. And I think that's the reason why this video series does so well on YouTube. This is probably it probably is my most popular video that I do on the YouTube channel every month, and it just gives you guys some ideas for some stocks to look at, and as well as that, it's transparency because everything I buy, everything I sell is always on this video series, so you can go back 7, 8, 9 years now, and you can see the stocks that I've been talking about that I'm buying, and you can see how they've done and the success they've had, and yeah, just really good for transparency. And obviously some of these, well, a lot of these stocks have done really well, and yeah, I think it gives people good ideas to look at some good stocks to be buying. And yeah, in my opinion right now, these are probably the more free, attractive one on the UK market. So yeah, hope you enjoy it. All these investments are for long-term holds, guys, for like the next 5 years. So just bear that in mind when you're watching the video. Apart from that, let's get started. Now, as always, if you do want to know what I'm buying and selling in real time, the place to be is on the Patreon. On there, you get to see what I'm doing in real time with notifications, as well as 2 exclusive videos a week on there as a thank you for supporting all these stock market information, these stock market picks I give to you. And it's £6 a month, or if you do sign up yearly, it's £60 for the full year. And we've just dropped an exclusive video on Nike, so go check that one out as well if you are on the Patreon. And as well as that, you get the Discord with 600 members to talk about stocks, including me. As well as that, if you do want to start investing, join Trading 212 with the link in the description. If you do, you can get a free fractional share worth up to £100. That's personally the investing platform that I use every year, and it's personally who I have my ISA with as well every year. So let's get into number one. Number one, B&M. I did start buying some more B&M, which was surprising. I did not think I would be buying B&M in the last couple of weeks again, but I did. So originally we did see a significant drop through February, March and April in B&M, and then we did see a bit of a rise. The stock rallied up 20 to 30% during the month of May. Now, in the last month, if you watched last month's video, I actually did take a little bit of profit off the table, locked in some gains. The reason why is I just thought, okay, I've been buying quite heavy. I'm going to take a bit of profit off the table just to rebalance the position out. And if B&M for some reason has another drop, I have the cash to go back in and buy. Now, I've got to say, I really did not think it would have a drop in the short term, but it has had another drop. As you can see here, the stock fell around about 25% between the 30th of May to around about the middle of June. And when that drop did happen, I thought, you know what, I'm going to go buy myself some more B&M shares. So it's a 2.7 billion market cap, around about 8 times earnings at the moment. It does pay a 5.58% dividend. Now, sometimes they do pay special dividends, which would push it up to a 10% yield, but that is not guaranteed. And as well as that, we've got a new management team coming in here, so we don't know if they are going to carry on doing the special dividend or if they're going to do share buybacks, or preferably what I'd like them to do is pay down the debt, because that is probably the only concern I have around B&M at the moment. So B&M, I'm sure most of you guys are aware what B&M are. If you are from the UK, they sell these discounted and fast moving consumer goods at the moment, and yeah, they're really good stores to go to. They're that popular, people actually make videos and vlog about going to B&M. So for example, this one here, 7 days ago, what is new in B&M, full store tour. If we do go down a little bit here, palm trees at B&M, bargains, 16,000 views as you can see here. This one, B&M shop with me and haul, 11k views 2 weeks ago. Yeah, people like actually vlogging to B&M because they actually have some pretty good stuff, I think, overall. Now, the big thing about B&M is they're having a bit of a tough time at the moment because they've been struggling to get the like-for-likes up at the moment. Now, in my opinion, the reason why is because they've just come off an inflationary year. They already put the prices up, and they can't really put prices up again so soon. And I think what will happen eventually is the like-for-likes will improve this coming year. Now, what also is reflected as being a pretty poor year for B&M. A poor year for B&M is where the revenue still go up 3.7%, EBITDA was up 0.6%, and adjusted operating profit was down negative 1.8%, which, yeah, the numbers could be slightly better, but this is what is a bad year for B&M. These are the numbers that has caused B&M to fall 40% in the last year. Straight away, you can see here, this wasn't really looking to me like a drop that is massively deserved at the moment. And the way that B&M are going to improve at the moment is to open up more UK stores. It is to make sure that the UK stores are continuing increasing their sales. And they have also started to move into France, and they're opening up more stores in France, which has been a very good growth driver for them, and hopefully get Herring Foods growing as well going forward. Like I said, that has now dropped it down to about an 8 times forward earnings at the moment, which I think is relatively low because this company is normally traded at towards 20 times earnings. Now, I don't think it'll trade down there. I think realistically B&M will be a kind of 12, 13 times earnings, which obviously is a big metric expansion potential from here, and also the growth and the dividend on top. Another thing that I would say is that when you do compare B&M to someone like other retailers, they normally trade around about 12, 13 times earnings, and B&M in my opinion is just as good as those retailers. You're getting nearly as good dividend as them guys. And the thing that people don't really talk about too much with B&M is they have very good profit margins. If you do look at B&M's profit margins, the profit margins are, come on Simply Wall Street, show me the profit margins, where we at. Yeah, historically been around about a 6% profit margin, which is very good for a retailer like this. If you want to go see Tesco's profit margins, it gives you a good idea what normally something like this trades at, which is obviously very good at the moment. Now, the market seemed to throw it under the bus on its full year results, and they weren't happy with the numbers. Maybe the reason why is because we already kind of knew these results because they gave us the preliminary numbers. But when the full year results came out, they're like, oh, we know these numbers, but actually, you know what we're going to do? We're going to send the stock down even lower. Which was a bit of a ridiculous drop to me, to be honest with you. Now, I think, in my opinion, and we'll see what happens because we're going to find out on the 15th of July. Now, I think what's happening here is they're going to do the Q1 trading update on the 15th of July, which is around about two weeks away. Okay. Now, what has happened in that time frame is we've had the new CEO come in. If we do look at the new CEO, he came in and he bought a ton of shares, which was on the 17th of June. And if we do look at the CEO, he bought around about 500,000 worth of shares, which is pretty a decent amount. And when you do look at some of the insiders as well, a lot of the insiders have been buying some shares as well, especially like the CFO, which obviously, you know, probably has the best grip of what's going on with the numbers at the moment. Now, in the full year results, they didn't do a Q1 update or any mention of how current trading is going at the moment. My thinking is because I want to get all the bad news out of the way, sink the share price down. The insiders come in and buy some shares, and then they report the Q1 earnings, and the Q1 earnings are actually pretty good. Why would I think the Q1 earnings are pretty good? Well, the thing is that we've just gone over a period of very warm weather. The warm weather helps people go out and spend more at retailers like B&M, and also at garden centres, like some of the garden centres that B&M have. They have like 250 or something like that. And also what falls in their first month is the Easter weekend. The Easter weekend fell in the first quarter of this year for these guys. So the combination of the warm weather, the reporting of the accounts, and also the Easter falling in the weekend, I think what we're about to see from B&M at the moment is they're going to come out and say that they had a very decent Q1 update, and all of a sudden we're going to see the share price have a little bit of a jump in the short term. Now, I'm in this for the long term. Like I said, in the long term, I do feel like they'll go back to growing these revenues with these stores opening up, and that'll increase the profit. Like for like will start coming back. I think B&M are going to start doing very well from a long-term point of view, but even in the short term, I'm interested what happens here as well at the moment. So we'll keep an eye on B&M. Number 2, no surprise, I made a video on, or a dedicated video on Hollywood Bowl the other weekend, and yeah, I'm a big fan of Hollywood Bowl on this dip at the moment. So yeah, Hollywood Bowl is having a bit of a significant dip at the moment. If we just zoom out here, really since about May time 2024, that's when the stock has peaked, and it's gone downwards for like about a year now, and we haven't seen a 28% dip on Hollywood Bowl since the 2022 stock market crash. So yeah, this is the biggest dip we've had since 2022 in the last 5 years. Now, I've been a shareholder for this one for around about 5 years now, so I do have some shares that are up a significant amount since I started buying during the CV times, but I just keep buying more and more and more because I just want more access to this 4.8, let's call it 5% dividend yield. And also, I think the future growth plans for this company are very good with the Canada expansion. I also think the CEO and the management team over here are probably one of the best on the UK markets as well at the moment. Now, if you don't know what Hollywood Bowl is and you've never been to one, which once again I think you will have done if you are from the UK, but they do these bowling alleys, but as well what they tie in is these food and drinks. So you might have the food and drink come to you when you're doing the bowling, or they have quite often these bar areas that you go to, and also they have a lot of amusements as well in the centres. So they tie these into like leisure parks where you might be going for some food to eat and then you go play bowling, or the cinema and then you go play bowling, or some other things like Laser Quest. So they put them in quite tactical locations and they get people to come in, and not always just for the bowling. Sometimes they go for the arcade and the drinks. And yeah, so they've got triple income coming in at the moment. They look absolutely fantastic when you do go to a Hollywood Bowl. I think it's one of the places where you go to and you're like, yep, these guys, you know, it's a good atmosphere when you do go in. Same again, these guys are going down at the moment because people said the H1 were poor. I don't think it was poor. The H1 revenue was up 8.4%. On an EBITDA point of view, it was up 8.8% on an pre-IFRS basis at the moment. And you can see here the UK total revenue growth was up 4.7%, but the big growth driver is this Canada expansion, and the Canada expansion was up 40%. So they're trying to replicate the UK business now and expanded into Canada around about 3 years ago now, and that is currently growing at 40%. Now, like I said, I think the market threw it down because when you do look at the profit numbers, they did go a little bit negative, but there was a lot of one-time charges in there at the moment. There was a bit of a weather impact going at the moment, and as we saw the awful budget where that meant costs went up, so admin expenses was up 15%, and you had the likes of the wage increases coming in at the moment. So I think this will be neutralized as we go on going forward, and I think it was just a big combination at once that's just impacting that profitability a little bit at the moment. UK, the target is to go up from 75 centres up to 95 centres by 2035, and in Canada we're expecting to go from 15 centres up to 35 centres. Now, if you do look at some of their revamping of these Canada centres that they do have at the moment, if you look at the pre-photos of what they look like to what they look like now, they look like the UK Hollywood Bowls. They look absolutely amazing, places where people want to go. And that's clear when you look at the financials. Like-for-like revenue up 133%, EBITDA payback in 3 years up 303%. And look at the growth on bowling, look at amusements, very much like the UK, which is great to see. Now, right now, this company trades at 11 times forward earnings on 2025 numbers, or 10 times earnings on 2026 numbers. This company normally trades around about 18 times earnings, so some metric expansion potential there as well. But in general, I think this is a premium UK company. When you do look at their financial execution over the last few years, if we just zoom out a little bit and go on the past performance here, you can see here the company went from 78 million up to 240 million, and they went from 5 million in profit up to 28 million profit. These guys have been one of the best financially executing businesses on the UK markets, and I would say this actually should trade at a premium more than 18 times earnings. I would say the case of 22 times earnings potentially. Financial health wise as well, this is a cracking balance sheet. They've got no debt on there. They also sit on 22 million of cash as well. And just to give you that little bit more of a confidence boost, the insiders have been buying as well, with the chairman of the board buying some shares as well. And we also had the CEO as well buy some shares, which was around about a 40k amount as well, which is very good. So yeah, I like Hollywood Bowl on the dip at the moment. And that takes us on to the last and final stock today, which is MOCO. So MOCO had a pretty significant dip during June. Not really any concrete reason why. Maybe they had a bit of a rating downgrade, and that's maybe the reason why. But I was looking and thinking, I don't know why it just continues to fall here. And I told myself I'm not going to continue buying anymore. And yeah, I did actually buy some, and it has had a bit of a bounce since, but it's been a tough time for MOCO. It's down 41% in the last year, and yeah, from where we were first buying this stock, which was in 2020, and we were up over 150% on this position. Since 2021, it has been pretty much a ski slope down, and it's all the way down at 29p at the moment. But I still think there is a business under here, and I do continue to buy. I will say though that this is a slightly more risky one because of the balance sheet at the moment. Now, most of you guys will know MOCO as National Express. They used to be called National Express, and then they did a rename, which was probably one of the worst renames that we have ever seen. Now, if we do look at the recent earnings, they were okay. The group revenue was up 8.3% and growing nicely. adjusted operating profit was also up 11 million to 187 million, which if you do work on an adjusted profit basis to the market cap, you are bang on nearly 1 times the current operating profit, which I don't think I've ever seen a company trade at 1 times their operating profit before, which shows you how low that is at the moment. They did take a impairment as well on the financials, so it does make the company look loss-making at the moment. And they did sell their America school bus business, which a lot of people did not like. I personally think this has been oversold because of this, because it was part of the business that wasn't making them any money. They got some cash for it and they can pay down some debt on there. People just felt like they should have got more money for it. And I think I made multiple videos going, I think this is what we're going to sell it for. And MOCO pretty much sold it for nearly bang on what I was predicting, slightly lower. So I just think this is people getting a few things wrong here. Now, the big thing is the ALSA, which I think if I say it proper is, I think that people call it the ALSA business. This is actually a very good part of the business. And I would have liked to see the new CEO actually come from the part of the business that this has been run at, and been doing very well. This makes up 51% of the revenue, and these financials are actually great. So revenue up 17%, operating profit up 39% to 219 million. With the operating margin up to 40%. This is this part of the business, like, this is why I continue to buy MOCO, because this part of the business is what people will want. And I think a few people might be staring at this and thinking, you know what, I can buy MOCO and all the other stuff and just kind of spin it off or just shut it down, and then I'm left with this part of the business. And this part of the business growing at 17%, with the profit going up 39% a year, 219% of adjusted operating profit. Yeah. You know, I think this part of the business alone is probably worth like a 1 billion. And when you do look at the market cap right now, it's 183 million. So yeah, this is a significant reason why I'm actually buying this part of the business. North America isn't actually too bad. That's growing at 11% with adjusted operating profit up 45%. A lot of that is coming from the We Drive You part of the business, with the revenue growing at 18.9%. So the America part of the business is actually looking quite healthy at the moment. The UK, not so good. Revenue only up 2% with operating profit down 72%. So this is a little bit of a problem that they need to improve at the moment. And Germany as well, that's been a bit of a weak part of the business. So really they need to strengthen this UK and Germany part of the business. And the rest of it is actually not too bad at the moment. Now, like we said, the adjusted operating profit actually went up quite nicely, but obviously people staring at the actual operating loss, and the reason why they had an operating loss is if you look there, goodwill impairment of school bus, 547 million write down. So a lot of people look at that and they actually, so if I go on Simple Wall Street, a lot of people go, whoa, look at those losses, and then they don't actually realise that it's not technically an actual, money amount of loss at the moment. So yeah, that's what I think a lot of people are making the error from that point of view. We've got a new chair coming in. We've got a new CEO coming in as well. If they do hit their full year guide for this year, that does put them around about 3 times earnings, which in my opinion is just way too low. Like I said, the balance sheet is not the best. You can see here there is very much high debt to equity at the moment, and the cash pile is just holding on there a little bit. That is the problem here. So we do have the new CFO appointed in on the 24th of June. Hopefully we'll get the new CEO coming in sometime soon. So yeah, a little bit of a mess on the balance sheet, but I still think when I look at this part of the business, this part of it, the ALSA part of the business alone is what I'm kind of buying this for. And I think ultimately someone's going to be thinking, you know what, I'm going to bin off the UK and Germany part of the business, and then you could maybe sell off the North America part of the business, get some money from that. And like I said, for me, this part of the business here alone, this ALSA part of business, this is worth, I would say, at least 500 million alone, which right now is over double the current market cap. So yeah, I'm taking a little bit of a risk with that one, but I keep adding into MOCO. And that leads me on to the stock I sold. So I did take a slight trim of my position. I sold about 5% of my position off for around about, I think it was either 43% gain or a 44% gain, which was game realms. So I did just trim the position slightly. The reason why is because the stock has had a fantastic year. It had a little bit of a drop the other day, but yeah, it's still up a good amount, up 43% year to date. And after holding this stock for around about 12 months, and the share price was pretty much staying stagnant for the 12 months I did own it, to have that nice little pop up, I thought, okay, you know, we're all here to make money, and I'm going to take a little bit of profit off the table now after holding this for a year. And if the stock keeps going up, which I think it will do, because I still think it's pretty good value, but if it continues to go up, I've still got majority of my money in the company where I make profit. But in the short term, you never know what's going to happen, and we're here to make money, so I'm going to lock in a bit of profit. The stock had a bit of a re-rating, so when I was starting to buy, the company was trading at around about 12 times earnings. It now has gone up to 17 times earnings, so it has had that metric re-rating going on. It's still very much below its average though, which is 22 times earnings, which is why I think the stock will continue to go up, because it's still very cheap value. The other thing that makes me nervous is there is, like we talk about with other companies in this space like DraftKings, there's a lack of iGaming states coming on at the moment, which makes me a little nervous about when these next iGaming states are going to come online, which is a key driver for gaming realms going forward. The other thing is the company is only expecting 10% growth this year, and that's a big slowdown from where it was previously at 25% last year. So yeah, I don't know why there's such a big slowdown forecasted, and that was also a little bit of a thing where I went, okay, I don't know if the market will freak out when it sees the slowdown and send the stock down a little bit. So I'm going to lock in a little bit of profit here. And that's what I did with Gaming Realm. So yeah, nice little way to finish off the month, making a little bit of money on a UK stock. You know, all those times that people, I always see in the comment section, why buy UK stocks? Well, there you go, up 43% year to date on Gaming Realms. And what's that, outperformed the S&P by 20 times? Yeah. If you can pick the right stocks in the UK market, you can do well, guys. So that's it for today. I hope you enjoyed the video. I don't know if I'll make a video on Monday, because I did bring it forward to Sunday. We'll see what happens. If not, I'll see you on Tuesday. Apart from you guys on the Patreon, I do have one more exclusive video coming your way. So if you do want to join us on there, then the link's in the description. Have a great rest of your Sunday, guys. See you in a bit.